Stop asking AI what stocks to buy, at least not until you've watched this video. You see, AI can be the smartest research tool that you've ever used as an investor, or it could be the fastest way to blow up your portfolio. And most people have absolutely no idea which side of the line that they're standing on. Today, we're covering the 7 mistakes that quietly cost investors real money when they use AI, and exactly how to avoid every single one of them. So, if you're ready, show it by giving that like button a tap, hitting subscribe, and let's get into it. My name is Lewis, and welcome to the AI Bureau. Our research team is made up of financial experts with experience in Wall Street investing, traditional assets, and crypto, and we've watched every one of these mistakes play out in real portfolios. And with that, here's why this matters right now. A majority of retail investors are already using AI to inform their investment decisions, and roughly 1 in 10 are using chatbots specifically to pick stocks. Meanwhile, a Deloitte survey found that 47% of enterprise AI users made at least one major decision based on hallucinated content in 2024. Think about that for a second. Almost half. These are professionals with compliance departments, and even they're getting burned. Oh, and a quick heads up, the 7th mistake on this list is the one that we see the most often, and ironically, it's also the easiest one to fix, so stick around for that. Now, mistake number 1 is letting AI trade on its own. This is the big one, handing AI full execution power with zero human oversight. Sounds like the dream, right? An autonomous bot quietly making you money while you sleep? Well, the data tells a different story. In a recent 14-day competition involving 13 different AI models trading with real rules, only 22.7% of the model runs finished profitable. Put simply, more than 3 out of 4 lost money. And when researchers analyzed 1,782 trades across 56 days, the single biggest drag on performance wasn't picking bad stocks. It was actually overtrading. And that's because these models are incentivized to act. So they trade constantly, and the fees quietly bleed the account dry. In fact, the most profitable models were the ones that traded the least. In some contests, doing the exact opposite of a popular AI model's trades was actually more profitable than following it. Let that sink in. And it gets even stranger. Research found that when AI models are tasked with maximizing rewards, they could develop gambling addiction-like behavior, going bankrupt in up to 48% of stimulated tests. And for retail investors specifically, over 80% of AI trading bot users lose money. And here's the math that makes this so dangerous. If your bot loses 50% of your capital overnight, you now need a 100% gain just to get back to break even. Capital preservation beats aggressive automation every single time. So what's the fix? Keep a human in the loop on every execution. If you do experiment with automation, hard-code circuit breakers the AI cannot override, things like daily loss. Limits and position caps, paper trades for at least 2 to 4 weeks first, and never, ever grant an AI withdrawal permissions through an API. Now, let's move on to mistake number 2, trusting stale information. Here's something most people don't realize about the AI that they're using. Most major models have a knowledge cutoff sitting somewhere around mid-2025, which means they literally do not know anything that happened after that date. It's not withholding information from you. It's just blind. Asking it about current prices is like asking a financial advisor who stopped reading the news last year to manage this year's portfolio. Now, you might be thinking, but these tools can search the web. True, but here's the trap. ChatGPT and Claude only trigger web search selectively. If browsing isn't invoked, the model silently defaults to its stale training data, and it won't warn you. It'll quote you an earnings figure from 9 months ago with total confidence. Researchers even have a name for this: accuracy decay. As a topic gets closer to the model's cutoff date, accuracy degrades while the tone stays exactly as confident. And here's the kicker. You can't even trust the model to tell you its own cutoff date, because models frequently get that wrong too. So, pro tip. Before trusting anything time-sensitive, run a quick freshness check. Ask the AI about a very recent, specific market event. If it can't answer correctly or isn't forced to browse, you're gambling on outdated memory, and that's a gamble that you'll lose. Now, let's go to mistake number 3, which is hallucinated facts and fake sources. This one connects directly to the last point, because a model that doesn't know the answer won't always say so. Many times, instead, it invents one. AI can fabricate statistics, analyst ratings, price targets, and even entire studies that sound completely credible but simply do not exist. And here's the genuinely unsettling part. An MIT study from January 2025 found that AI models are statistically more likely to use confident language, words like definitely and certainly, when they're hallucinating than when they're actually correct. The confidence is not a signal of accuracy. If anything, it's a warning sign. There's also what analysts call the precision illusion. A fabricated PE ratio of exactly 31.4 sounds far more authoritative than a vague estimate, and that fake precision switches off your skepticism. I mean, how common is this really, though? When raw financial documents are fed into AI, the industry average hallucination rate sits around 20%. That's one error in every 5 queries. And counterintuitively, the newer reasoning models showed hallucination rates of 33 to 48% on factual recall because they could reason their way into plausible sounding wrong answers. These tools have even invented entire regulatory frameworks, citing rules like IFRS 99 that don't even exist. The fix is simple, but non-negotiable. Demand citations that trace back to actual filings, cross-check important claims across multiple models, and never ask an AI to remember a number. Instead, make it retrieve one. And by the way, if you're enjoying this video so far and want more ways to use AI properly, why not sign up for the AI Bureau's weekly newsletter? It's completely free and will show you exactly how to get the most out of this once-in-a-generation tech. Just click the link in the description below or scan the QR code that's on the screen. Now, let's get back to the video and talk about mistake number 4, which is treating AI output as financial advice. Everything that we've covered so far, the stale data, the hallucinations, leads to one inescapable conclusion. AI gives you a starting point of research, not a verdict. And here's the part nobody thinks about, the accountability gap. A licensed financial advisor is bound by regulation, with the complaints process and real consequences for bad advice. AI tools explicitly disclaim all responsibility. If a chatbot's confident answer loses you $20,000, there's no regulator, no recourse, nothing. The money is just gone. And the advice itself has structural problems too. One study found that AI-built portfolios loaded 41% into semiconductors, doubling their 21% weighting in the S&P 500. Why? Because AI picks stocks based on media coverage volume, not fundamentals. So you end up buying the loudest names after they've already run up. There's also a crowding paradox here. A University of Florida finance professor pointed out that if AI were genuinely better at stock picking, mass adoption would erase its own edge. And the data backs that up. As more people used one AI for stock picking, its risk-adjusted performance in one analysis collapsed from a Sharpe ratio of 6.54 down to 1.22. The edge evaporated. And it gets worse, because scammers know exactly how seductive that this all is. The SEC recently sued a Texas man over a $12.3 million crypto scheme that used fake ChatGPT letters to manufacture legitimacy. So, treat AI as one step. Use it to summarize earnings calls, flag red flags and filings, and brainstorm ideas. Then verify everything with primary sources and your own judgment. Now, let's talk about mistake number 5, which is oversharing your financial data. So far, we've talked about what AI gives you. This mistake is about what you're giving it. A recent study found that 27.4% of all content fed into chatbots contains sensitive information, things like account details, addresses, and financial data. That figure is up 156% year over year. And when it comes to file uploads, more than 20% contain sensitive information. That's people uploading entire portfolio statements without a second thought. Here's the problem, though. Virtually every major consumer AI provider uses your chat data for model training by default, unless you actively opt out. And deleting a chat, well, that's mostly an illusion. Deletion typically removes the conversation from your view only, while the data can persist in backups for 30 to 90 days, or may already be baked into training. Remember the accountability gap from the last mistake? Well, it applies here too. Your conversation with a lawyer, a doctor, or a fiduciary advisor carries professional secrecy protection. Your conversations with the chatbot carries none. Even linking accounts in read-only mode is risky because one account takeover hands an attacker a consolidated map of your entire financial life. So here's the golden rule. Never share with AI what you wouldn't post publicly. Use ranges instead of exact balances. Redact account numbers. Disable the Improve the Model toggle in your settings. Use temporary chat modes for sensitive questions, and turn on multi-factor authentication everywhere. Now, mistake number 6. False confidence and backtesting traps. Now, this is where even the more sophisticated users get burned. You've avoided the obvious mistakes, so you ask AI to backtest a strategy or find patterns in historical data, and it hands you something beautiful, a strategy with stunning historical returns. Here's the uncomfortable truth, though. The overwhelming majority of backtested strategies fail in live trading. And every error in backtesting is biased in the same direction: optimism. Take survivorship bias. Testing only on stocks that exist today inflates annual returns by 1 to 3% because every company that went bankrupt has been quietly erased from your dataset. It's the famous World War II bomber problem. Engineers wanted to armor planes based on where returning bombers were shot, until a statistician pointed out they were only studying the planes that survived. The planes hit in the fatal spots never came back. Analyzing only surviving stocks has the exact same flaw. And research by Hendrik Bessembinder found that most listed companies failed to beat short-term treasury bills over their entire lifetimes, a reality completely hidden by survivorship-biased data. But here's the AI-specific trap almost nobody talks about. When you ask an AI to backtest a strategy through a past period, it already knows what happened. It knows when the crashes hit and when the recoveries came, because that history is in its training data. It's taking an exam with the answer key in its pocket. That makes any AI run backtest of the past structurally invalid. Pro tip, if a backtest shows a profit factor above 3, that's usually a red flag, not a jackpot. Robust real-world systems land between 1.5 and 2.5. If your reaction to an amazing backtest isn't asking what broke, you haven't seen enough backtests. And mistake number 7, the one that we promised at the start, is vague prompts. It's the most common mistake of all. And yes, it's exactly what's sitting in this video's thumbnail. Typing, "What stock should I buy?" into a chatbot. In financial use cases, roughly 80% of output quality is determined by input quality. A lazy question gets a generic, media-driven, tech-concentrated answer, and now you know from mistake number 4 exactly where that concentration leads. The research shows prompt clarity reduces irrelevant results by roughly 42%, and adding contextual detail boosts accuracy by around 30%. So, instead of asking what to buy, try something like, "Suggest 3 healthcare stocks with strong balance sheets and growing dividends, and cite the specific filings supporting each claim." Now, the output is constrained, specific, and most importantly, verifiable. That said, don't swing to the opposite extreme either. Wharton's generative AI labs found that obsessive prompt optimization can become expensive procrastination because prompt variations produce inconsistent results and endless tweaking often just optimizes random noise. The lesson ain't magic words. It's context, constraints, and verification. State your goal, your risk parameters, and your time horizon. Require source citations, and ask the AI to flag what data it's missing. And one more thing, prompting is never one and done. A prompt that worked last month can produce confident nonsense after a model update, so always pressure test your outputs. So where does all of this leave us? Well, here's the bottom line. AI is a powerful co-pilot for investing, but it is a terrible autopilot. Remember, fewer than 1 in 4 autonomous AI trading runs finished profitable. The investors actually winning with AI follow a simple workflow: scan, verify, analyze. AI scans for candidates, A second layer fact-checks against live data, and the human makes the final call. In other words, use AI to cover your weaknesses, the panic selling, the emotional bias, the drudgery of research, while you cover its weaknesses, the stale data, the hallucinations, and the fact that it knows nothing about your taxes, your liquidity, or your life. And here's the optimistic part. The models keep improving, with newer versions cutting factual errors by roughly 33%. The tool gets better every year, but these 7 disciplines stay exactly the same. Master them, and AI becomes a genuine edge instead of a liability. And there you have it. The 7 mistakes: no autonomous trading, no trusting stale data, no unverifiable facts, no treating output as advice, no oversharing, no blind backtests, and no lazy prompts. Dodge all 7, and you're ahead of the vast majority of investors using these tools today. If you found this valuable, show that like button some love and subscribe to the channel, because we break down how to use AI properly each and every week. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.